Before we start the podcast, Andy, I just want to say a quick word about our sponsor, Fidelity International. Now, Fidelity International is one of the biggest fund platforms in the world, as one of the biggest fund managers, and they manage billions of pounds for millions of customers worldwide. Now, Fidelity have a whole range of funds which you can choose from. They have best buy lists, and they even offer suggestions for where to invest this year's ISA. Some of those come from Tom Stevenson, who is their investment expert, and you will probably have seen in the national press. If you want to find out more about Fidelity, then go to fidelity.co.uk. I personally actually use Fidelity to run my own 50k portfolio on 80/20 Investor. Fidelity are also running a competition this ISA season where you can win back the amount that you invest in your ISA as hard cash. So go check out their website for more information.
Hello and welcome to episode 214 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leeks. Damien, how you doing, buddy?
I'm good actually. We've had a bit of a first this week because we videoed the Midweek Markets podcast. So if you've been listening to the Midweek Markets podcast, our intention has always been that we will video and put out the video on YouTube and various different social media channels. We did it this week, so go and look at our YouTube channel. It's the same audio, it's exactly the same audio as the podcast you listen to, but you can watch me do it, and it's good. Andy's done the editing, it looks fantastic, so we're going to do that going forward, and we will start to video parts of this podcast, and we're going to do another show as well, completely new one that is aimed at a more millennial type audience as well on video. So all these things are coming together, so it's great to actually get the ball rolling on that one, because we've been trying to do it, but it's been so busy, but we finally done it.
We did, and so what you'll need to do is just go onto YouTube, type in Money to the Masses with no spaces, and you'll find the channel there. And do us a favour, like the channel, subscribe to the channel, and press that little bell, the little alarm, and that will tell you when you get your next video, and it'll actually send you a little alert to say that there's another Midweek Markets available to watch. That'll be cool.
That would be really good.
What do we got on this week's pod?
So we're not going to be talking about the spring statement. The spring statement was
boring.
It was a non-event. So it's basically the interim that we had between the budgets, which are now in the autumn. So there's a statement that was read out by Philip Hammond about the state of the economy, and there wasn't anything too exciting in that, and that's partly because we're imminently going to crash out of Europe, but it actually looks more like, we're going to just stay in it forever. So what we're going to do is talk about some different things. First of all, it's about HMRC and the scams that have been going around, and we want to just warn people. But in a wider point, talk about some terms like spoofing and phishing that are related not just to HMRC but other scams. So regular listeners will have heard bits of it before, but it's worth reminding everybody. The next two pieces on the podcast are inspired by questions from some listeners, so two listeners, and they're both on an investment theme. And it's around what will happen if your investment platform goes bust. What happens to the money that you've invested? And more importantly, what happens to your money if the funds that you invest in within or via that platform, if they go bust, what happens? What protection do you have? It's one of those great questions that people don't seem to know the answers to, so I'm going to go into that. And the third piece is around investment trusts versus unit trusts. So two different types of investment. There are a lot of general similarities, but there are very big differences. So what are they, and which do I prefer?
Excellent. So we're going to start on the scam theme. There's been another one doing the rounds lately, and it's hit the news this week, and it's regarding HMRC, and it's sort of focusing on the phishing side of scams, isn't it?
Yeah, there's phishing and there's spoofing. So what we've had is, this time of year is there's always a surge in HMRC related scams. So just to give you some big numbers, last year HMRC managed to stop 300 million fraudulent emails going out to people, claiming to be from them in order to try and scam them in some way. We'll come on to how some of those work. They also managed to remove 16,000 websites last year from people who were trying to, again, scam people. But this year there's been perhaps an increase, a more alarming trend of spoofing, but actually what the people are doing. So spoofing is where somebody can ring you or they will text you and they hide their number, but not just hide it, they can actually imitate a number that they want to. So they could ring you, and apparently the number they could be ringing from appears to be genuine, i.e. from HMRC. They are able, via technology, to be able to imitate numbers that they don't own. So just because a number rings you and it looks genuine, or a number texts you and it looks genuine, and it can even fall into the feed or stream of text you've had from that person previously, it doesn't mean it's genuine. So that's spoofing. They're basically providing a false identity. But what's been happening is that people have been receiving calls from somebody, or people claiming to be from the HMRC, but saying that the person is under investigation and there's a warrant out for their arrest for some form of tax dodge or misfiling of tax returns, and demanding payment and bank details. Now, we've had there's a case where a lady lost more than £4,000 doing this, and then the fraud came to light at a later date. The thing to remember is HMRC, they will never ring you up and ask you for bank details. Your bank won't do it. So if you receive a call, supposedly from a bank or HMRC, asking you for personal details, then I would put the phone down, then go and find the legitimate phone number from the website of the company you thought it was from, be it HMRC, and then ring them, but from a different phone. Now, the reason why you don't call back on the number that you're given by the person on the phone is because it could be, again, if it's a fraudster, they'll give you a fake number. And also the reason why you do it with a different phone is because there's been fraud cases where people actually stay silent on the other end of the phone. So the person thinks they put the phone down, the line is still connected. So when they then dial away and think they're ringing up the genuine number, the fraudster on the other end then just unmutes their mic, and then they answer the phone as if they are another person from a call centre. And of course it's the same person on the line. So that's why they say call from a different phone and use the genuine number you find separately online via the genuine website. So be aware, we're going through a period where there's a lot of these scams out there. We've had phishing, which phishing is with a PH. Is slightly different, but whereby you get emails that try to send you to a very genuine looking site. I've had many of these. It could even be to your bank. I had one in the past that actually sent you to a website that looked very much like my bank. You wouldn't know any different, but the experience was slightly different. So in my case, when you wanted to go through, they started asking you for your whole password rather than just part of it. And what they might even do is keep saying there was an error and getting you to try different combination of letters so they work out what the full combination is. So rather than saying first, third and fifth, they would do that, go, sorry, can we now have the second, fourth and sixth? And by that point, they've worked out your genuine number. What they're doing is trying to work out your genuine password, and then they go on and input that detail, the real details, into the genuine site and then steal your money. So that's phishing. Just because a site looks real when you go via a link, it doesn't mean it is. So what you're better off doing is going actually again out searching for the genuine site on Google, go into it and then logging in. So don't click on links via emails. I never click on a link via an email, even if it seems to be genuine and from my bank.
I think another good tip is you generally know when things are cropping up and if you've got issues. So if something like this comes to you completely out of the blue, then you should use your instincts and you should query that and question it.
Yeah, and just be suspicious of everything. And another thing I want to say is that just because you fall victim to a scam, it doesn't mean you're stupid. It doesn't mean you're foolish, because these scams are very convincing. And a number of times, all of us, and myself included, I've almost clicked on things and then almost reacted to it. They know the little buttons to push to trigger those human emotions where you'll suddenly panic. So don't feel stupid if you feel foul of it. Just report it immediately to the police and action fraud as well. Now, 2 resources I just want to point you towards is millersmiles.co.uk. So Andy will link to this, Miller and then Smiles. That is a database of these fraudulent emails out there. And they tend to keep them online. It's just basically a treasure trove where you could go through and search the database. So it helps you determine if an email is genuine or not. It was regularly updated. I think they've started to move slightly into a more professional version where they're actually allowing companies to pay to see the emails that have been sent fraudulently, supposedly from them. But they still have a database you can search. But the other thing is, if you go and Google HMRC examples of bogus contact, you will be taken to a website on the official government site that will give you examples of some of the bogus contacts that are coming through out there, including fake phone calls and things that people are saying to people who are being victims, targets, as it were. So go and have a look at those resources. But the moral or the message of this piece is just to be vigilant, particularly around this time of year.
Find out how fit your finances are for free with Damien's Money MOT. With no registration required and no need to access policies or paperwork, you'll receive your own personal grade, together with a breakdown of where you should focus your attention, all in the time that it takes to boil the kettle. Crucially, you'll get to see how you measure up compared to everyone else, and even get your own tailored plan on how to improve your score. Simply go to mot.moneytothemasses.com. So sit back, relax, take Damien's free Money MOT, go to mot.moneytothemasses.com to get started, and reward yourself with that cup of tea afterwards. Okay, so we've got a question from a listener about platforms and significantly what happens if the platform goes bust, but also what happens if the actual fund house within the platform goes bust and what you can do. So there's a question here from a guy called Andy, great name. And the question goes, "Hi Damien, love the podcast. Keep up the good work. I currently invest in funds such as Vanguard Life Strategy, and I've got a couple of questions for you." And so the first question Andy asks is, if my fund platform were to go bust, and in this case it's Interactive Investor, would I still own my own life strategy funds?
Right. I'll give some context to this, because basically, if you imagine that you can own Vanguard's life strategy funds, you don't have to own them via Vanguard's own platform. You can actually own those funds via Hargreaves or Interactive Investor. So that's the investment platform. That's the fund supermarket. The product, the fund itself, are the Vanguard funds, in this particular case that Andy holds. So his first question is, if the platform goes bust, would he own the fund, the Vanguard fund, still? Now, the answer is yes, he would, because what happens if you invest via a fund platform, then your money gets put in the Vanguard funds, and it's actually meant to be ring fenced. It's actually put in an account that's in your name. You own those funds. So in the context of Interactive Investor, unlikely as it would be to go completely bust and cease to exist, then the funds of Vanguard, the ones that you own, will be in your name and they still exist. So in that regards, you are safe.
Right.
But, I mean, I'll then jump on, actually, because I know where this is going to lead, and actually save you reading it out, Andy, where we're going to go next with this, because let me just talk about the platform itself. So the Financial Services Compensation Scheme exists for savings, and it does for investments. Now, there is a quirk, a difference, that if you have savings in a bank account that's authorised by the FCA and it's covered by the Financial Services Compensation Scheme, then in the event that that bank goes bust, you would get back £85,000 of your money, up to that amount. If it's a joint account, then it's double, so it's £170,000. And that limit is based upon per banking licence, not per brand. So if you get a case where a bank has a licence that covers multiple brands, like HSBC or First Direct, if you had accounts with within each of those brands, you'd only have one FSCS limit. So you have to be careful. Now, what's happened with investment, the limit was only £50,000. So some good news is that from April this year, that limit is jumping up to match that of the savings account. So you probably didn't know that, because it was only it's a relatively recent announcement. So from April, you will have £85,000 worth of cover on an investment. In theory, investment platforms are covered by that because they're an investment company that is covered under the regulation and they're authorised by the FCA. So if Interactive Investor went bust, then you are covered for the amount of money. Now, that's obviously if there was some sort of fraud, because as I've just mentioned, when you give them the money and you invest it, it actually goes to the fund house. So the fund house is where your money is, and the platform is administering it. It begs the question, what then happens if the fund house goes bust? And the answer to that is that you have that limit, that new £85,000, currently £50,000 if you're listening to the podcast at the moment, but from April 2019 it will be £85,000. You have that per fund house. So if you have a fund with Vanguard, you have one with Artemis, you would have that limit, and so you'd be okay if you spread the risk around. So it begs the question, would you pick different platforms, have multiple platforms and multiple funds? It probably would be unnecessary. It would be the most safe thing to do, but you've got to think about, if you have multiple platforms, then you're going to have multiple fees that are going to pay, because some of them charge admin fees, not just percentage fees. So that will start duplicating. Of course, the funds within it are ring fenced, but even within those fund houses, your money is ring fenced within those as well. So it should make people feel relatively safe that they have all that compensation scheme there. But it does mean that if you've got millions invested through these, that there is an element of liability. Now, the idea is that you should be secure in that knowledge. But as the podcast we did last year, where we talked about Beaufort securities, what's meant to happen is platforms are supposed to have, and investment companies are supposed to have money like a kitty that's meant to be there, so if something goes wrong, the administrators can actually sort things out. And what happened, there were rules that were changed that allowed the administrators to start dipping into people's investments to pay for the administration process. And cut a long story short, there was a big hoo-ha about it. We did a big podcast about it. The Financial Services Compensation Scheme stepped in and people didn't actually lose money in the end. So you've got to think about it. The Financial Services Compensation Scheme's been set up. They want to try and protect people. There is another interesting question, actually, because what are the rules around having cash within something like a SIP? So you have a pension, a SIP, on a fund platform. You could have cash. Now, what happens, you actually have a limit, that £85,000 savings limit for that cash in a SIP. But the thing to bear in mind is that where that money is held is important, because if the institution, the bank, is the same bank as you have money with externally, separately in your everyday life, then you've only still got one £85,000 limit. So if you had a £85,000 of a bank in savings and then your SIP had some money in that same bank, because that's who Interactive Investor used or whatever, then you still only got the one £85,000 limit, so you are technically at risk. The one other thing that people might not be aware of with the Financial Services Compensation Scheme is that there's a temporary increase in the limit. So now we talk about £85,000, £170,000 for joint accounts. If, for example, you sold your house and you had a load of money going to your bank account just at the point that your bank went bust, you do get covered up to £1 million for 6 months. There's a temporary 6-month window that if you have money in there and it's only for a 6-month period, then you can have cover. But you would have to prove where the money came from. So it was from the sale of a house. And I mean, let's be honest, in that scenario, that's the first thing you'd want to do. You're going to have a problem with that if you're going to lose £1 million. So there is some extra safety nets. And the other thing just to mention is some people wonder, how does it work? Well, what really happens is if your bank goes bust, then it could be, there was an example, there was one recently went bust, and what they did is if you had under, say, £1,000, you could actually go and get that money from the post office. It was arranged, you could get it immediately. If you had more than that amount, and obviously it was less than the £85,000 limit or under limits for the compensation scheme, you were paid by cheque, and it's supposed to be within 7 days, and that's likely to be working days. So you can see that the Financial Services Compensation Scheme, the rules are all set up. They don't want banks to go bust, and if they do, they want people to be compensated, because the last thing they want is a run on the bank or a run on the financial services, because if we had that, then there's a real danger to our economy.
Excellent stuff. So we've got another investing question, and this one comes from Richard. He checks that you're feeling better, and I think you can confirm to listeners you are feeling better.
I am feeling better, but as they can hear, I can't seem to shake this sort of heavy cold. It seems to resurface every now and then, just as I'm about to record a podcast or video. So I think it'll be here till doomsday.
Yeah, we jinxed. I don't know if you've already covered this, but it would be interesting as to why you prefer unit trusts over investment trusts. All the best, Richard.
Right. Before we start that, I'm going to just put in a bit of admin, because I've just realised I was going to mention on the podcast that on the 3rd of April, so this is one for your diaries, and I'm saying it now because I know at the end of the podcast, when we get to the end, people start to switch off. On the 3rd of April at the London Assembly, I am doing a panel discussion with some influential people, the CEO of Habito, which is the online mortgage broker that you see the adverts around everywhere. There was going to be the CEO of Nested, and there was going to be the CEO of Moneybox. So, you know, the app that if you can save, it rounds up money, and if you're spending, you can save money, pennies, into an ISA. So it's a clever app. They'll be talking, and there'll be a Sunday Times journalist they're interviewing us, and the theme at the moment is going to be around building businesses that actually innovate and do things, sort of disrupt things and innovate in the sort of fintech world. But more importantly, it's going to have a focus around buying property, particularly for first-time buyers. So make sure you come along, because we really want you to come along. And I'm going to bang on about this every week, because all you guys who came along to all the different things we've done, I could name you all, but I feel like I'd be putting pressure on you to come, but I am. I want to see you all there. If you've never been to meet me, it'll likely be Andy and Lauren and Justin and the rest of the team will come. Please, please, please put it in your diary. I'll give you more details as we get them in the next couple of weeks, but it'll be a brilliant night, and more importantly, it's about us meeting you. So you come along, listen to the panel discussion, you'll learn a hell of a lot. It'll be good fun, but also we can then all go and meet up and do whatever it is we do, and we want to have our pictures taken with you and chat to you and have a drink, etc. So it'll be good fun for you to meet us. So it is as big a deal for us, if not more so, than it is for you, and we want to get as many people to come along, because it also looks very good if all you guys come along when I'm on the panel. So that's also a personal bit of bribery.
So again, that's the 3rd of April in London at the Assembly Room. Come along.
Yeah, so come along. Anyway, back to the question.
So Richard asks, I don't know if you've already covered this, but it'll be interesting to know as to why you prefer unit trusts over investment trusts.
Right, the answer is I don't. It's a legacy issue. So most people only are able to, or historically have only been able to buy unit trusts. It's the most popular form of investing. And I'll explain the difference in a minute between unit trusts and investment trusts. But when I was trying to show people how to run money, there's no point in them showing them how to... it's a bit like saying, how could you do the fastest lap round Brands Hatch or any other racing track, and you're going around a Formula 1 car when everyone else is driving around in a Mini. So I had to try and I wanted to use the same tools that everybody else had when we did 80-20 Investor, to try and show them how they could do things and build portfolios, and even use things like momentum to be able to try and outperform the market. So I don't prefer one over the other, but I do tend to use unit trusts for that reason. Now, the downside of unit trusts versus investment trusts, unit trusts trade and are priced on a daily basis. So if I want to switch out of a unit trust into another unit trust, it can take a couple of days. An investment trust is more like a share, so therefore it works almost instantly. And there are lots of platforms allow you to trade for free on unit trusts, but they don't on investment trusts. So if you're going to keep switching, unit trusts do have their advantage. You don't have to pay too many fees, but they have the disadvantage. They're not the best in terms of being out of the market when you do switch a lot, but sometimes that can work against you or for you. Now, unit trusts and investment trusts are often called funds. They're just given that sort of general name, but the differences are that apart from the ones I've mentioned, unit trusts are open-ended and investment trusts are closed-ended. So you may have a unit trust that invests in UK equities run by a fund manager, but they will create as many units, so basically portions that you could buy, as there is a demand, and they can actually get rid of them as well. So there's a price of that unit trust, and it's determined by basically what the portfolio is doing. The police are coming. Can you hear them, Andy? I don't know if we get that in the podcast. Yeah. I'm going to leave it in if we can hear it. Someone going after the scammers, I think. Now, investment trusts are close-ended. Now, if you imagine a company that all they did was invest in other companies' shares, and that was it, and therefore they had a floated and they had a share price, the value of that company's shares are based upon the shares that they actually own and they are managing and trading in. That is basically what an investment trust is. So that's why they're a share and they trade like shares and they have a share price. But there is only a finite number of them, just like there are only a finite number of shares in a company, whether it be Apple or Microsoft or anything. There's a certain number. It's not infinite. And so what happens that where the slightly different to unit trust, where the value is deemed upon the value of the assets, the value of the investment trust is influenced by the value of those assets that they own, the shares, but it's also more importantly influenced by the supply and demand of the shares in the investment trust itself. So to give you an example, Neil Woodford, he is having a torrid time at the moment, but he was once upon a time lauded as the sort of son of God in terms of investing and investment management. He did have a great track record. When he launched his investment trust would trade at a premium because people would go, oh my God, it's Neil Woodford, he knows what he's doing. And even though the value of all the shares that his company owns are worth X, I'm going to pay even more for that because I know that he's going to manage them, buy new ones, sell the ones he's got and make even more money. I'm willing to pay for that. There's a demand, so it was at a premium. But conversely, when you get to a point where they are unloved, and Neil Woodford is unloved at the moment. If an investment trust becomes unloved, it means that actually the share price of the investment trust itself can be worth less than the sum total of the shares that they actually own in other companies. So that is called a premium to NAV, the net asset value, or a discount to NAV, the net asset value. What that means is that you've got a sort of a double risk there. So the price you're going to get an investment trust at is going to be dictated by this premium and discount, the supply and demand. So there's sort of two factors, and when you're investing in them, you've got to take that into account, because you could buy into an investment trust at a premium, but then it only goes to a discount, and vice versa, but it's going to affect your ultimate profits. Now, some people, there's no hard and fast rule that you should always buy at a discount or sell at a premium or anything like that. Some people will have certain views on it, but there is no exact science. Really, you want to buy something because it's good, and the fact it's at a discount can be an advantage. It doesn't mean it's bad, but occasionally things are at a discount, like anything in life, because they are terrible. So that is one of the differences with investment trusts. The other thing is, because they're companies, they have different rules, and it means that they can trade in different ways to unit trusts, and they can do different things. And one of the things they can do is they can borrow money. So it's called gearing. So they can amplify their returns by borrowing money and investing. A unit trust can't do that. So it means that you get to the point where they can amplify the gains, but they'll amplify the losses. So an investment trust, by its nature, will tend to be slightly more volatile than an equivalent unit trust because of that. So you have to bear that in mind. The other thing is that, and a positive, this is a general positive, that investment trusts can be great income investments, because a unit trust, when they get the income from the dividends of the companies they invest in, they have to then pay that out. An investment trust is allowed to keep 15% of any money it makes in a year and actually hold that back and pay it out at a later date to smooth it over. So you can see that the income can be smoothed out, which is why if you look at any article that talks about the best funds for income portfolios, you will sometimes see investment trusts mentioned, because they have shown a history of growing their payouts over years and years and years. So that is a positive of investment trusts. On the flip side, so you can tell there's positives and negatives to each. You just have to bear in mind those differences. In terms of performance, I don't think you can draw a general rule, but I have seen research that tends to suggest that investment trusts perform better than equivalent unit trusts over the longer term. And it's not in all cases, but they've done a general, I've seen the research, and it does tend to suggest that they do. And I've seen elements of that. You get some really good returns on investment trusts, but you've also got those other elements, like I said, about the pricing, which adds another layer of risk, and the gearing that adds a level of risk that you just need to be mindful of. They are a different beast to unit trusts. The thing is with unit trusts is that, don't forget that in days gone by, unit trusts paid financial advisors commission for when they sold them. Investment trusts didn't. So that is partly the reason why we have that legacy of unit trusts being incredibly popular. But now, thanks to RDR, that is less of an issue, because advisors have to charge an upfront fee, and there isn't any commission wrapped up into the funds themselves. So in answer to the question, I don't prefer one over the other. I just show people which to use, and I just show people how to use the ones that are most popular. In time, I'm thinking of actually creating an investment trust and ETF portfolio on 80/20 Investor and running that alongside my unit trust one, for that very reason, to show that how you can pick funds and use them. And of course, people on 80/20 Investor, I give them that data anyway for investment trusts and ETFs, which they can use and do use themselves, even though I don't build a portfolio as an example for people to look at. So that is it, Andy. I think we've managed to squeeze it all in this week.
Excellent stuff. So there's just a few bits of admin just to remind people who have diligently listened to the end of the podcast. Do get onto YouTube, search for Money to the Masses, subscribe and like our videos on there, because there'll be lots and lots to come. If you want to get down to the Assembly Rooms to see Damien, do so. It's April the 3rd. And of course, if you haven't done Damien's Money MOT, get on there and do it. What are you waiting for? It's hitting the news. It's big. It's a big story.
It's been in the newspapers and in the press, and We've had about 4,000 people do it already in the just in the couple of weeks it's been out, which is fantastic. But we need to keep pushing. We need to be able to change the finances of the UK, Andy.
We do indeed. So if you want to get in touch with Damien, it's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with a number 2. And for those of you young pups, you need to get onto Instagram because there's loads of fun stuff on there too.
Yeah, and of course you can email Andy at moneytothemasses.com.
Until next week.
Until next week.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.